JP Morgan Chase, Bank of America, Citibank, their stock prices are trading at or near all-time highs. The indexes that track financial institutions are surging. If you just look at the headlines, you would think everything is absolutely fantastic. American household debt just crossed $18.8 trillion. Why those two records happening at the exact same time is not a coincidence. Second quarter earnings for the major banks came in and they were outstanding on paper. Trading revenue was strong across the board. Capital markets activity, meaning things like initial public offerings, bond issuance, mergers, and acquisitions, all of that was humming along. And then you layer on top of that a growing sense of optimism around where interest rates are headed. Investors believe rates have either peaked or are close to coming down, and that expectation alone is enough to send bank stocks higher. When you combine robust trading desks, active capital markets, and a favorable rate outlook, you get a recipe for bank stocks to absolutely rip higher. JP Morgan Chase, which is the largest bank in the United States by assets, has been on an absolute tear. Their revenue numbers were massive. Bank of America showed strength across multiple divisions. Citibank, which has been going through its own internal restructuring, still managed to post numbers that impressed Wall Street. These institutions are not small operations. They are sprawling financial empires. And when all three of them are winning at the same time, it tells you something very specific about the environment we are operating in. Because most people hear bank stocks at all-time highs and they think, oh great, the economy must be doing well. And I understand that instinct. But you have to ask yourself a deeper question. How exactly are these banks making so much money? Banks are in the business of lending. That is the core of what they do. They take in deposits, they lend that money out, and they profit on the spread. The wider the spread and the more lending they do, the more money they make. So when bank profits are at record levels, it means lending is at record levels. And when lending is at record levels, means debt is at record levels. More interest being paid towards the banks. See how that works? American households right now collectively owe $18.8 trillion. That number is almost impossible to comprehend. The single largest chunk of that is mortgages. Home prices have been elevated for years now, and even though higher interest rates slowed some activity, people still need places to live. The mortgages being taken out today come with significantly higher monthly payments than they did just 3 or 4 years ago. That compounding cost is real, and it is baked into household budgets for the next 15 to 30 years. Then you have auto loans. The average price of a new vehicle has skyrocketed. People are financing cars over longer and longer terms just to make the monthly payment manageable. 6-year auto loans used to be rare. Now 7-year terms are increasingly common. That means people are underwater on their vehicles for a longer period of time, owing more than the car is actually worth. Credit card debt in America has hit $1.26 trillion. Credit card interest rates right now are averaging over 20%. Some cards are charging 25 or even 30%. When people carry balances at those rates, the math becomes almost impossible. Minimum payments barely touch the principal. The debt compounds month after month, and the banks collect interest the entire time. Now connect the dots with me. Every single dollar of that $18.8 trillion in household debt is a revenue line on a bank's income statement. Every mortgage payment includes interest that flows to the lender. Every auto loan payment includes interest that flows to the lender. Every credit card balance that rolls over from month to month generates interest income that flows to the lender. The banks are not hitting all-time highs despite Americans being in record debt. They are hitting all-time highs because Americans are in record debt. The system is working exactly as designed. When a bank reports record trading revenue and strong capital markets activity, those are impressive. But the bread and butter, the foundational engine of bank profitability is net interest income. And net interest income goes up when more people owe more money at higher rates. That is the math. There is no way around it. So, when you see a headline that says JP Morgan posts record quarter, I want you to mentally add the subtext, which is American families also owe a record amount of money. Those two things are directly linked. One feeds the other. the health of the banking sector in its current form is inversely related to the financial freedom of the average household. The more stretched consumers are, the more profitable the banks become. Now, I am not saying these banks are doing anything illegal. They are operating within the rules of the system. And I am not saying that all debt is bad. Strategic borrowing has its place. But there is a difference between strategic borrowing and an entire population that is collectively drowning in compounding obligations with no clear path to paying it all down. Here is what really worries me going forward. If interest rates do come down, which is what the market is currently optimistic about, that could provide some relief on new borrowing. But it does not erase the $18.8 trillion that already exists. Those rates are mostly locked in, especially on mortgages. And credit card rates have historically been very slow to come down even when the federal funds rate drops. So the existing debt burden stays heavy even in a falling rate environment. And if the economy slows down, which rate cuts often signal, then you have a situation where households are carrying record debt into a potentially weakening job market. That is where the risk really lives. Delinquency rates on credit cards have already been ticking up. Auto loan defaults have been rising. These are early warning signals that the weight of this debt is starting to crack the foundation. The banks will be fine for now. They have massive reserves and diversified revenue streams. But the American consumer is the backbone of this economy. Consumer spending drives roughly 70% of GDP. And when consumers are stretched to their limits, carrying record debt, paying record interest, eventually something has to give. So, the next time you see bank stocks hitting all-time highs, do not just celebrate the number. Ask yourself what is fueling it. Because behind every record bank profit is a family making a minimum payment on a credit card they maxed out buying groceries. Behind every strong earnings report is an auto loan that someone is paying high interest rate. The banks are not winning in spite of your debt. They are winning because of it. And until we start talking about both sides of that equation, honestly, nothing is going to change. If this opened your eyes, I need you to share this with someone who needs to hear it. Drop your thoughts in the comments below and make sure you subscribe because we are going to keep breaking down what the headlines are not telling you. Thanks for watching.